Welcome to Keen on Retirement, a show dedicated to helping you thrive before and during your retirement years. If you are looking to grow and protect your wealth and want to make the second half of your life the best half, then listen in as wealth advisor Bill Keen sorts through the key issues that you need to know in a lively and candid way.
Hello, everybody, and welcome back to Keen on Retirement. We got another great episode lined up here today, and we have another great listener question that we're going to tackle. But before we get into that, guys, Matt, Bill, here we are. We're into September already. Football season is kicked off. Kids are back at school. We've had Labor Day. What do you guys got? What are you looking forward to here this fall?
My goodness, Steve. Well, one thing I'm looking forward to is lower electric bills. We had a hot August there, late July and August. So I had the biggest shock of my life, as they say, when that bill came in. So I think Carissa had the HVAC people over to the house, though. We might have had some issues going on, but that's not very exciting. How about pumpkin spice lattes? How about that this time of year?
Oh, yeah.
Do you drink a lot of those?
I'd love that to be a year-round treat.
Oh, my
I'm
goodness.
sure you can buy them, Steve.
Yeah. I can make them at home too, I suppose. But
Yeah.
Yes, you could. They have some good coffee up in your neck of the woods. So,
Mhm.
this is
Yeah.
kind of old news, but I'm sure our listeners and viewers have seen this. Steve, I know you follow this closely, I'm sure.
Sure.
Travis Kelce and Taylor Swift are engaged. You saw that come out a week or two ago.
Yep.
Yeah.
Well, we can't accuse this of being a whirlwind romance. I think they've been together for some time now, and they're both mature adults, I would say. And
Yeah.
so, gosh, wish them the best. Probably, I'm sure the NFL is excited about that because it'll give the NFL another thing to be talking about. Who knows? Maybe Taylor's going to be moving to Kansas City.
Oh, you never know.
Yeah.
I know our listener question.
I would say that's probably a no.
Who knows?
I think the odds on that one are pretty low.
Pretty
Well,
low.
how about multiple residences? I'm certain of it.
Yeah.
Well, does Kelce live there? Does he in the off season? Does he live in
he
Kansas
might have
City?
a home here. I don't know if you could say he lives here.
Mhm.
Yeah, I think. I don't recall about a year ago, Matt, or so. He made a move, I think, but it's that's what's in the media. So
Yeah.
I do remember that he lived up in the north part of town there for a while and was getting a lot of traffic up there in an area called Briarcliff. Matt, do you remember? And was getting a lot of traffic when he started dating Taylor. So they moved out south somewhere. But again, don't track it specifically too closely. But I suppose we'll keep our eye on what's happening.
Yeah.
Maybe we could run a retire. Our listener question today comes from a couple. I'll let Steve introduce it here in a moment. But about their retirement question. Of course, it's our focus of our program here, Keen on Retirement. But I would suppose some of the retirement issues that Travis and Taylor will be dealing with will be a little different, right? More estate planning focused, probably.
Yeah. Probably prenuptial agreements too, I'm sure.
Well, that's a good point, Matt.
Just
I'm
thought
glad
of
you
that.
brought that up. Yeah.
Yep.
I mean, two hugely successful people, and Taylor, I dare say, is more financially successful than Travis is, although Travis is no slouch. But
How dare you?
yeah, that'll be
Steve.
very, very interesting to see to see what they. I'm pretty sure that they would have a prenuptial agreement, and be interesting to see how they would work that out. Of course, I don't think that'll ever be made public, but I'm sure that'll be some dandy conversation there.
Oh
That's
boy.
What would
Yes,
you
it
guys
will.
advise? Okay. I mean, what would you, any like high level questions that should be asked going into that? I know we're sort of deviating here, but that actually, I think, could be an interesting conversation. Like, how do you guys approach prenuptial agreements, just generally speaking?
Yeah, we typically deal with them when it's later in life with folks. A lot of times it's one of the spouses may have passed away, and we always recommend someone see an attorney and just make sure that they're on the same page with a lot of that stuff, because you don't want to start commingling assets and going down that path without just certain things in place in case something happens. And even more so of it in our situation is, well, let's say now one of the spouses in this new marriage passes away,
Mhm.
who gets what? Are there kids from previous marriages? That's the bulk of it. Then it is, a lot of times they're going to keep assets and finances separate just because they're used to it that
That's right.
way. It's more about the beneficiaries.
hmm
That's right. Like you said, the estate plan, trust work, even,
Yeah.
which does control a lot of those things. You would hate to have, your own kids disinherited. These are hard things to talk about when you're going through things like
Yeah.
that. But typically, like to Matt's point, which is a great point, Matt, these are what I call, quote, normal folks, not rock stars, movie stars, professional athletes, but people that are going through life and dealing with things like this, maybe the loss of a spouse, and then recovery from that, and being able to maybe find someone new to enjoy life with,
Mhm.
making sure those things are buttoned down, and like you said, it's not maybe as um, combative, I suppose, up front. It's just smart and prudent,
That's
really.
right.
hmm Yeah. Well, maybe we'll do a separate episode on prenuptial agreements
Yeah.
someday, because I think that's it's an important topic. It's part of financial planning. It's part of the value that an advisor can bring and a estate planning attorney can bring to the conversation, and obviously has severe financial consequences if things are not done the way you want them to, and can lead to big family problems. We've seen lots of times where, it is kids from different marriages, and
Mhm.
one or two kids are favored over other kids, and then they sue each other, and it just becomes really ugly. So
Yep.
Yes, it
won't get
does.
into that today, but maybe that's a future episode. So yeah, let's dig into today's conversation, which is a question here from a listener. Really good one, really interesting, and I think this will really highlight how to think about financial planning, how to think about financial advisors. The situation is, we have a couple, husband, wife here, that talked to two different financial advisors, and they got a little different opinion on their question, which was essentially, can we retire? Do we have enough money to retire? And one of the advisors basically said, yeah, I think you should probably keep working. And the other said, yeah, you can retire. And so on the surface, it's like, well, why would two financial advisors give different opinions on something as important as, do I have enough money to retire? So really good idea. Good question here to dig into. So let me just give you some of the particulars of this situation. We don't have all the information, but this is what we have. And we'll try and make as good as some conversation here as we can based on this. So we've got a husband, let's call him Mark, age 62. We have a wife named Lisa, age 60. Their goal is to retire together within the next year. In terms of their financial situation, they have about $1.8 million in investable assets, a traditional 60-40 split, meaning 60% are in equities or stocks, 40% are in bonds or cash. They have 401ks and IRAs with about $1.2 million. Total brokerage account assets, $400,000, $200,000 in cash. So pretty substantial assets here. They have a house that's paid off worth about $600,000. In terms of Social Security, Mark is eligible for $3,800 per month at his full retirement age of 67, or about $2,900 per month at age 63. Lisa would be eligible for $3,300 at full retirement age of 67, or $2,300 per month at age 62. They have no pension, and they will need healthcare coverage until Medicare kicks in at age 65. In terms of their spending goals, their desired lifestyle is to spend about $100,000 per year after tax. And then in terms of healthcare premiums, before Medicare kicks in, they're looking at about $18,000 per year in healthcare premiums. And then they'd also like about $15,000 per year for travel and extra discretionary spending for the first 15 years. So the big question is, can they retire? And again, one advisor said, yeah, you can retire now. The other advisor said, you can wait. I would love to hear, you gentlemen, what your thoughts are. How would you tackle this particular situation?
Yeah. It's an interesting question, because this person, this couple, Mark and Lisa, I'm sure they're coming at it thinking, well, isn't the answer the answer? Like, why is there
Sure.
different answers based on meeting with just different people? They probably think of it like going to do your taxes. Shouldn't
Right.
the end result be the same?
Black and
Sure.
white. Right.
Yeah, maybe personalities are different, but the taxes are the taxes. Well, we do know, of course, there are some things that maybe some tax preparers or CPAs aren't paying enough attention to or not aware of, so they forget to ask those questions. So there are, nuances that do come up within the tax code, but to have a situation where someone says, yeah, go ahead and retire versus like, no, you should probably wait. And I'm thinking they're probably suggesting they wait till they're closer to 65 or 65, because that's a common age for people to shoot for, because Medicare kicks in at that point and you're that much closer to your full retirement age for Social Security. But let's kind of dig into, I think, why, let's call it advisor A. Why would they say that they could retire now? What would be, I'm kind of thinking out loud here. What are the planning assumptions
That's right.
that they would have that would allow that to happen? Well, some of the key inputs are rate of return, because you have to assume some sort of return. And how are they evaluating that rate of return? Is it a linear rate of return? Meaning, you can plug into a spreadsheet. We see people do this all the time. You're going to make 6% a year and you're going to pull out 5% a year. Well, that works indefinitely.
Forever.
Yeah. Yeah. Maybe you build in a little bit of cost of living and there's a crossover point at some point, but that tends to work pretty easily. However, we know that doesn't happen in real life because, returns are variable. Spending actually is variable for a lot of folks. That isn't just hey, we know exactly what we're going to spend for the next, number of years in retirement. And inflation's no one knows what inflation's going to be. So those all are factors when it comes to the spending side and what the return in the portfolio is going to look like. I'm guessing there's probably a little bit of that going on with this first advisor, where it's maybe more simplistic on the planning from the investment side, and that's not uncommon. There's no right or wrong way. I really, what I wanted to say, there's not like some legal definition is you have to plan this way.
Right.
This is how you do it. Everyone does it this way. No one knows, what the future holds. So people have different takes on it. And again, there isn't hey, you have to do it this way or that's not accurate or incorrect.
Let me ask you a couple questions here around that. So one is, how much of financial planning is an art and how much of it is a science? Simply like it's the math. What would you say to that question?
Yeah. So the answer I'm going to give you, no one's going to like, but I'd say it's, in my mind, it's 50-50. Because there's the technical things, which are very mathematical, and tax planning. There's a lot of math involved. We know exactly what the tax code is for this year. In most years, sometimes we don't know exactly what it is until December, once Congress finally finalizes it. But most years we know exactly what it is, and we can run through the math, run through the numbers, and be very accurate with the tax planning on a year-to-year basis. But the art side of it is, this couple, without them sitting in front of us, how important is it for them to retire sooner than later? How stressful is the job? That could be something that, for either of them, hey, this is not fun. They don't like doing this anymore, and they're experiencing health issues. Maybe one of them had a health issue that came up over the last few years, and this is just something they've really been thinking about, and they'd much rather retire sooner, knowing that we may have to adjust our lifestyle in the future. Because, they just gave us their spending goals. Well, some of it's discretionary. They've defined that with their travel bucket of $15,000 a year. Well, how much of the $100,000 a year of their desired lifestyle bucket is discretionary? There's, a portion of it. It's not all just earmarked for everything. It's got to be a portion of it can be flexible. So, that's kind of where I would say the art side of it comes in, because we got to help people make decisions with the information in front of us that's in their best interest too. Not just say, well, you should wait just because it'd be easier.
That's right.
That's just more of the easy answer.
Over for me now, 32 plus years of seeing how the planning software, so the tools that we have to help people analyze these things, has evolved over many years. And I think the tools are about as, of course, there's robust as they've ever been due to technology. But when you can layer real experience of seeing real clients in real life retire, see their resources, see how things played out, and then see how what the planning software told you would happen, and then what really happened. I think that's a valuable thing that we have here, Matt. I mean, if you think about it, between the two of us, we've got, 55 years or so, something like that, of getting to see this happen for real. One of the other things we've talked about in an episode that you interviewed us once, Steve, about our meeting process at Keen Wealth. We talked about kind of the first meeting that we walk through when someone comes to see us. It's the process that we've created, whether it's Matt and I in those meetings or one of our wonderful credentialed advisors or a team of them, is the questions that you ask. And I think in that episode, we recommended folks really think about, when you go see an advisor, really take note of the questions you're being asked, because it gives you some real insight into the depth of the process and the art and the science of what you're walking through with that particular advisor. And questions that Matt just brought up, he mentioned, and you took it right off my tongue, Matt, like, was there a health issue around work? Is retirement imminent? Like, you're retiring whether you want to or not, maybe even. Matt, you've done plenty of webinars about folks, we think we're going to retire at a certain age. And I think some high percentage of people retire earlier than they thought they were going to, due to a health issue, a downsizing, or to care for a loved one. Those are things that questioning someone, asking the appropriate questions, are super important. Here, we don't talk about kids either. So we're not seeing kids and grandkids. We're not seeing in the data that you provided, Steve, any discussion about what this particular client, Mark and Lisa, would want to have left at the end. Now, we don't know the end date, speaking to the art of it here, but we have some ranges that we can plan for. But what would they like to leave? Do they have legacy goals, or do they not? One thing we've shared on our program many times is that, from our experience in all these years that I mentioned, majority of our clients have more money than they've ever had in their life at the end of their life. Now, maybe that data set selects because we work with a lot of process-driven people in the engineering community, and they're savers by nature, or just the folks that we have maybe even attract or that like our material. They're planners by nature because we're so planning oriented. So they select into that kind of group of people that are not going to overspend their resources, and they end up having more money at the end of their life than they've ever had, which I used to think was success. And I still think it's better than obviously running out of money at some point. But I question, is that success, or would those folks rather have had more confidence spending, donating, sharing some of those resources, creating memorable experiences while they were living, as opposed to leaving it at the end? So, and again, everybody's different, and we honor and acknowledge every single person's desire and every single person's journey around these things. But I think what you said, those questions that we asked, that you even mentioned there, Matt, are super important. And then we get down to that point of where we're running these financial plans. You have to be updating these things. So this is not a set it and forget it, yes or no, and you're done for the rest of your life. It's something that has to be looked at regularly, ongoing. Matt, when we think about this, tell me, was Advisor One the yes or the no? I can't remember.
I would say they were the yes. Advisor A, Advisor One, that was the yes. You can
Okay,
retire
so
now. Yep.
we're assuming that these folks are meeting with a fiduciary advisor. They're going to be giving the advice that's in the client's best interest, and that advisor is not just telling this client, "Hey, tell them they can retire so we can get a hold of their 401k and money and manage it for them." We've been on both sides of this, so we've
Mhm.
seen it both ways. And we're going to always be extremely objective. We're going to say what we think is true. We're not going to make someone work way longer than they should, but we're also not going to tell someone they can retire when we know they can't. So this one sits kind of on a balance where, like has happened here, it could go either way. But think about, let's, for our listeners, and let's do a thought experiment here and our viewers. What would be a situation here where we would say, Matt, absolutely not, you cannot retire? Like, we could see that this is it's not going to work. We could say that the investable assets were 500,000
Sure.
instead of 1.8, or that they need 200,000 a year to live on instead of 100,000 plus these ancillary expenses. Like, there are some really obvious examples where they absolutely should not retire. And then on the other side of it, if someone came in this situation, instead of having 1.8, they had 4.8, we would say, well, my goodness, you absolutely can retire. So you could stretch it out into the obvious factors, give those examples. And now we work back to the middle, which is where we are today, coming together here saying, what do we think? Yes or no?
And did you happen to run this in your software by chance to see what you guys would recommend, just based? Well, I'm going to imagine you did, knowing you guys, how you prepare for these conversations.
You've also hit us surprisingly at points in time. Like, remember, there was a few times where you've given us things we didn't know were coming. So this time we kind of had a little bit of insight on this. So
that's right. Okay. Yeah. So we did. We ran this through our our planning tool set, and there is some interesting kind of results based on just the initial input with no adjustments. Here is the asset base. I assume they retire in basically January of 2026. We're pretty much at the end of this year, so let's just say beginning of 2026 they're retired, both retired. Plugged in the Social Security benefits, and the result, it came in at a 62. And for those that aren't familiar with our terminology here, the result, what we look at is an analysis that takes into consideration 1,000 different scenarios, looks at good market returns, bad market returns, different orders of returns, how those returns actually happen, and what, do you get good returns up front or do you get bad returns up front? That makes a big difference. And we run 1,000 of them because we really want to understand kind of where is the sensitivity to the plan. We also, our default and our standard procedure is to use more conservative return assumptions going forward. Historically, they've been better.
Yes.
But we start there. Doesn't mean we don't talk about the other ones, but that's just where we start. We also use a pretty basic 3% inflation rate. So assuming they're going to need 3% a year every single year for the rest of their life. And we run these out into the early 90s. That's our kind of default on the life expectancy side. If they were sitting in front of us, we would dig in a little bit more on the health side and life expectancy. Is longevity in the family, or is it not? We don't always just adjust the end of plan, as we call it, or the date of death, but we do want to understand that because that could influence some of the spending decisions that people have. But yeah, the result being a 62 just tells us, well, out of those 1,000 simulations, 620 of them ran all the way out to the end of plan, and they never had to make an adjustment. So they ended at least with $1 left. I mean, most likely it's significantly higher than that, but the plan worked fine. The orders of return, everything came back in normal. And that's one of the things that maybe this advisor A is comfortable with. They may not be going into those types of details with the client, like, hey, over 50% is fine with me because there's a higher likelihood than not that this is going to work.
Sure. Minor
Yeah,
adjustments might have to be made.
Yeah.
That type
So
of thing.
so that's 62% of the time when you ran those 1,000 simulations, they were okay. They did not run out of money and they did not have to make any adjustments.
That's right.
Okay. So from a quote industry standard perspective, what does the financial planning community say is sort of the target range of percentage that you're typically comfortable saying your plan looks good, you're in this range and you should be okay? Is there a standard range that you typically look at?
There is, and it's between 75 and 90. That's a very common place for most of the people that are using tools like this to kind of shoot for. And that, again, it's not a set in stone. It's definitely flexible based on what planners think is reasonable. But that's where we like to target initially, especially when they're making the decision to stop working. They're probably making the most they've ever made. Getting back into that profession or that career probably isn't going to be easy to do. And, the first several years, yeah, sure, they're probably going to be fine enjoying retirement, but the issues arise, especially if someone's overspending or if the returns aren't as good as what the plan kind of estimated. Then, well, when you're in your 70s and 80s, going back to work is definitely a lot more difficult. And it's towards that second half of retirement where you're really going to see the issues, or the spending that they estimated just wasn't accurate enough.
Right. Matt does a
Occasionally
whole presentation on spending in retirement. It's part of the educational programs that we provide when we go into companies and provide programs, and even the counsel that we give to our clients here is get conscious of what you're spending before you retire. Get conscious of, really do the work up front. A lot of times we start with what you're clearing now. Look at what you're clearing now if you're still working. Making sure that that's easy to see. You can see what you're clearing on your paychecks. Good starting point.
Yeah, if you're not going backwards in debt.
Yeah, as long as you're not spiraling backwards out of debt or building up consumer credit cards and things, we know that's working. So that gives us a good summary. And the other thing that we're looking at is when I think a good advisor is not just checking boxes off, filling in dollar signs and decimal points, but they're paying close attention in all of the meetings where we're getting to know a couple, know a family or an individual if we're seeing them, but especially in this case that I'm speaking of, a couple. What has their relationship to their spending been like in their past as they've built their wealth over time, as they've gone through their marriage? Has it been a struggle? Has there been one spouse that's been kind of a spendthrift, that's spent more, that's had a hard time staying within budget, that maybe a couple times throughout their lives have had to come in and do a refinance on the house to pay off high interest cards, and they hit it just right because rates were low and it didn't really blow their plan up? But that's happened a time or two, and maybe it's not one or the other; it's both. I mean, we look at old patterns of spending and then kind of where they are today to give us a sense for are these folks ones that were, and likely not, because I said it up front, they are the folks that we work with typically select against this dynamic, but are they folks that are going to be pressing the high end of what they can be spending? And we don't get sucked into that. Now, if somebody says, hey, just put us in the most aggressive investments you have, make us more because we want to overspend, that's a recipe for disaster if an advisor gets sucked into that. So we have to help people find that balance, but we're looking for those characteristics on folks when we're making this assessment. It's not just a vacuum. Yes, the score helps, but there's these ancillary items that we have to, if you're paying attention as an advisor, I know we have a lot of advisors and financial planners that listen to our program, you got to be paying attention to those things, because that's going to be predictive of what might be coming in the future. Taking care of adult kids that have had a hard time launching.
Yeah.
Those are things that we've seen that are come up unexpectedly to folks where they had their spending plan, and then they one or both spouses just can't finally say no to a child that's really compromising their retirement. And those are hard conversations to have, but it's all part of it. And that's why we ask. I talked again about the questions we ask. That's why we ask about children and grandchildren and siblings, and are there parents that might be reliant upon you for money in the future that you're not taking into consideration of, you're not thinking about when you're coming up with what you need to spend in those initial years? Did your kids move to the coast, possibly Oregon, Portland, where things are a little higher cost of living if you have to move out there by the grandkids? Oh, wait, Steve, that's what you did. You have experience in that.
But we have no sales tax here in Oregon.
Oh, that's right. That's right.
Yeah. But we have high income taxes and high property taxes. Yeah. So it all balances out. I do want to go back to the assumptions here, because I think that can also obviously have a big impact on what the outcome is. So like the return assumptions.
Oh, yeah.
If let's say the markets have done great the last 10 or 15 years, if you use the assumptions of market returns for, say, the past 10 or 15 years, and let's say they've been really good, versus you go back to the last 60 years, and maybe it's 2 percentage points lower than the last 10 or 15 years, that obviously can have a big impact. So maybe this gets back a little bit to the art versus the science. Whether you're an aggressive financial planner, whether you're a more conservative financial planner, and I'd say regardless of where you land, you need to let the client know, how did we come up with these assumptions? How do these assumptions compare to what historically has happened? So how do you think about that?
Yeah. We definitely, so one of the choices that we have is to adjust the return assumptions. And occasionally we will. I mean, definitely if our conservative kind of planning, our baseline it's close. 62, we're targeting 75 and 90. There's that is actually pretty close. And there are things that we would talk to them about is like, well, what if you worked one more year? Or what if you spent $6,000 less a year, $500 a month? Or hey, we're running this at a 3% inflation rate. And, again, no one knows what inflation's going to be like, but realistically, as you age, your spending doesn't just compound like that. We've experienced it with our clients. It's not every single year they're letting us know they need their 3% cost of living adjustment or whatever the cost of living increases are.
Matt, I said that on the first, I will never forget, when we first started doing this. Steve asked, one of our very first episodes 10 years ago, just almost 10 years ago, was what is a financial plan? And Steve asked me questions about our assumptions. And I remember literally now, this is like 10 years ago. Let's just round, it's not quite, but almost. It's 9.5 years or close to 10. And all these episodes are still out there live, by the way. It's like a live diary that exists. We haven't changed one or pulled one down this entire time. So if anybody had the time and cared, they could go back and see what we were saying 10 years ago, 9 years ago, 5 years ago, and test it against what actually happened. It's actually kind of unique. That they're out there like that. But one of the things I talked about was that exact thing, is that at that point in my career, 22 or 3 years, I hadn't seen people taking the year in and year out inflation adjustments on their earnings, and as they got older, they spent less by choice, not because they had to spend less. And so 10 years later, to your point, that's still what we've seen. And you could say we didn't have as much inflation, but back then. But now you could probably say no. Actually, we've had some. We've had both, right? We've had both, and then we've had not a lot, and we've had a lot. So.
Yeah, and those are things that we talk through and look at. I mean, those are all realistic things. Another is, well, if you delay Social Security to age 70, that can have a positive impact on plan results. Again, there's a lot of factors, life expectancy and the size of your current asset base, because you're using income from somewhere, whether it's from Social Security or from your own assets. But Social Security it does increase at 8% a year the longer you wait. So there is an increase in that income base over time. Plus, there's the annual cost of living increases that are added to that when Social Security provides those. So those are all things that we look at. Another one is, we can look at different rates of return. So we have the ability to say, well, what if the next, call it 30 years, has been more like the previous 30 years? historical returns. Well, that generally has been, a couple, 3% higher in terms of the equity returns, and a little bit higher on the bond side of things for those assumptions from where bond rates are at currently. And the plan result, just with that one change, not changing anything else, goes from a 62 to an 87.
To an 87? You
To
said
an
87.
87. Yeah.
So just a minor change in, our projected capital markets assumptions to historical, all of a sudden, boom, one little click of the mouse.
Yeah.
And when you
it's
say
like, well, which
historical,
one's right?
yeah. So when you say historical, like how far back historical is it? What time frame is it looking at for historical?
It's, the last 30 years.
Last 30 years. Okay.
Yeah.
And remember, bonds paid, short-term interest rates were down at 0 for a while too. So it wasn't like bonds were super high. They're in there.
Right.
There was a decent
variation
of
little
things
bit
that happened.
Well, people forget in the late 90s, 10-year treasury yields were close to 6%. They were much higher than,
That's right.
And mortgages were higher too, but everyone gets used to the 0% rates on everything, and it kind of skews your short-term thinking. But and we're not trying to say, well, hey, we can make it work by changing these assumptions. But what I like to do with folks is to help them understand, well, there's a range of possibilities.
Yes.
Again, we don't know what the future is going to hold. And while, we're going to start conservative, that's just our nature, because we want people to be very confident and comfortable as they go into retirement, and not feeling like, well, I just have to watch the stock market every day, because if the market doesn't make the rate of return that my plan assumes, then we're going to be out of money, or I'm going to have to go back to work, because that people kind of take that thought process, and that definitely can be a factor if rates of return and the assumptions in the plan are significantly higher than where they probably should be for someone to be, comfortable with that retirement. So we want to just help people kind of understand, like, just by using a higher rate of return just doesn't mean, okay, all of a sudden it's like, we're going to just show you which one works. It's more of, hey, there still is possibility that things will have to be adjusted in the future. That didn't change. That concept didn't change. It's just, we don't know. And we want to make sure people just understand what those options are. And too, considering how important is retirement to them versus, hey, if you worked a year or two more, or, another possibility is there some sort of, can you go part-time? Is there a different role at your current employer? Could you find part-time work on your own just to make, maybe if you even made just a couple grand a month?
How about benefits? Bridge it out to
that
65.
can bridge it out. Yeah, exactly.
Right? To Medicare.
Or one of the spouses is still okay and enjoying their work. They're like, well, I could possibly, continue to work while the other spouse retire. There's so many different options that you can help people think through and understand, versus just, nope, can't retire, or yes, you can retire. I mean, there's so many possibilities, and
So
just helping people understand that.
Yeah. So let me summarize here. So I got two key takeaways from what you guys have just said here. So one is, in this particular situation, where let's assume these are two competent financial professionals, they gave different answers. And so one thing, as an active consumer investor here, is that you do have to play a bit of an active role in your own financial plan, meaning you need to understand what's going into the plan, and you need to understand what are the assumptions that the advisor is using, and do those assumptions seem appropriate? So there's a bit of a sensitivity analysis. So whether you're using a rate of return going forward of, let's say, 8% versus 6%, that could determine whether you get a 62% probability of success or an 85% probability of success. And I'm just making those numbers up there.
Yep.
So you need to understand, like, what's your level of risk. So basically some sensitivity analysis. And then the second thing that you're really highlighting here, Matt, is there's a lot of options. There's a lot of levers here.
That's right.
And so it's not like you're going to go to bed on a Monday night and you got plenty of money and you're going to wake up Monday morning and now you're broke and you have to go back to work. I mean, it just really doesn't work that way. So you're going to have some advance notice if your plan is starting to run a little bit short, and you'll have plenty of time to make adjustments, whether that means you reduce your spending, whether that means maybe you get a part-time job. So there's all kinds of levers that can be pulled here so that you're not going to be blindsided and realize, oh my goodness, I have no money.
Right.
So that's not going to happen. So, I think that's the beauty of planning, and that's the beauty of working with a professional who knows what they're doing, is they can share all of these options. They can share the sensitivity analysis. They can talk about the different assumptions that are being used here, and they work with you ongoing, that if things start getting off track with the plan, then you get together and you talk about it and say, hey, here's some options. What do you think? What feels good to you? What makes sense? What trade-offs may you be willing to make? That sort of thing. So, that's what planning is all about, is making sure that there's no big surprises there. Does that make sense? Do you guys agree with that?
Oh yeah. Yeah. It's a dynamic process. This isn't static.
That's
It's
exactly
ongoing.
right.
Yep.
And that is the power of it. And, we love it, don't we, Matt? We get to love walking alongside all these families that we have the privilege of serving and getting to see them, the joys they experience, and getting them to see them live life in retirement. I mean, nothing makes me happier. I ran into somebody last night up north, Matt, who'd been up in Alaska, and they'd been all around. They'd been gone for 4 or 5 months, and it didn't go exactly like they thought because their rental RV broke down, but they just ended up flying somewhere earlier and changing plans because they didn't have anywhere to be anywhere, and they ended up getting a rebate. I just admit, it just makes my day hearing how much fun they had. And we get to hear story after story after story about folks living life to the fullest in retirement and making adjustments when necessary. We also walk alongside folks during tough times as well. Yeah. And that's certainly a privilege too. But, I don't think I could let this episode go by without, any of our episodes, and maybe every 10 or so, I like to bring up my trick question about when is the best time to retire from a financial standpoint. But, we do a lot of educational sessions. We used to do a lot of them in person, still do some, a lot of webinars. And I would have a room full of engineers and employees from engineering firms. And I would say, I'm going to ask you all a question. And they're very engaged. And I said, what is the best time to retire from a financial standpoint? And they would think about it and they'd be quiet. And I say, let me repeat it one more time so I don't trick you. What is the best time to retire from a financial standpoint? From a financial standpoint only now. And I would go ahead and say that. I was kind of giving them the answer, but a lot of them wouldn't bite.
What answer did they give you? Did anyone ever throw out an answer? Or?
Yeah, well, they threw out a lot of answers. I mean, I received 62 because that's when you can first start taking Social Security. Yep. I received age 65 because that's when Medicare kicks in. I received age 59 and a half, which is another key age where you can access money from your IRAs and 401ks without a penalty and without jumping through other hoops. I received age 70 back, then at that point when we were doing these more live seminars, that was when the RMD age kicked in. So there was quite a few of those, all good answers, all rational, good answers. But I would always catch them all. And I would say, except the ones that had been multiple times, and plenty did, because we had, nice lunches at those things. The answer is the best time to retire from a financial standpoint only. Truthfully, the answer is never. Because from a financial standpoint, you could always work one more year. You could always save more money. You could always also avoid spending money in the very same year that you're saving money. So it's almost like a double positive if you keep working, and a double negative if you don't, because you're not making money, you're not saving, and now you're pulling money out, as opposed to working, saving, earning, and letting that money grow. So from a financial standpoint only, if that's all the question really was, the answer would be never retire. Well, we know that's not reasonable. We know people have a second half of life, just like I say in my book, Engineering the Second Half of Life. That does not include having to go to work every day unless you really wanted to. And that includes doing things that feed your soul, doing things that take care of your health, spending time with family. Not that you couldn't do that if you still work to some extent, but for most folks, they like to make a break and say, what is that second half look like? So there's got to be somewhere in there where you meet a crossover point where that extra year of work, that extra year of savings is no longer worth an extra year of your life, which ends up time becomes the priceless asset here. So I think if I had to be forced on this to give you an answer, I'm going to go with, And I'm still kind of confused about if advisor 1 was yes and advisor 2 was no. I think advisor 1 was yes, they could retire.
Yes.
Mhm.
I'm going to go into the advisor 1 camp and say that these folks could retire, assuming we were able to sit down with them and clarify a few extra questions. How about we put it that way? I think they can make it happen here when they're wanting to here in about a year based on the case facts that we have. What do you think, Matt? Putting you on the spot here.
Yeah. I mean, they have a lot going for them, and even just looking at the makeup of their investable assets and not knowing, did they inherit some of this money or not? But they have a brokerage account of $400,000. They have cash of $200,000. Well, that makes me, and they have a home that's paid off. They're not. They've been good savers, and that has probably been excess cash flow.
That's right.
So some of their desired lifestyle, I think, is definitely some discretionary spending. If push came to shove, they would probably be able to pull back some. Versus someone who just doesn't have those buckets, or just they just saved differently, and they spent what came in, which is perfectly fine. Nothing wrong with that. But I think there's a lot of margin in their expenses.
Good.
I do too. And Steve, not to go back into the detail, but something came to mind, and we're free associating here for our session today. Matt, I know most of the time we don't assume the equity in a house. We always, in our planning process, like our default is not to use that value in our initial assessments of someone's ability to retire. Like we just assume they're going to have to live somewhere. So we exclude the value of the home initially from the financial planning process as far as running the reports. We carry it obviously for a net worth statement, but at some point, the majority of our clients that we have not included that will either turn that house into cash at some point to move into a retirement community or to be able to rent. There's a lot of people, we might actually do an episode on, there's a lot of people 55 and plus that are looking at renting instead of owning homes nowadays. That's been a trend that we've seen. So all of a sudden if someone decided to do that, which is what you essentially do if you move into a retirement community in a lot of cases, is that equity that we're not carrying all of a sudden turns into cash as well, which could make their plan even more probable as well.
Good. All right. Well, I think we will wrap it up there. So again, a couple takeaways. One is there's a lot of sensitivity analysis that can be done here. So make sure that we really understand what the assumptions are. And then the second is there's a lot of levers here that can be pulled. And so we're not going to go broke suddenly unless you're taking some incredible risks that no competent financial advisor would ever suggest that you do. So that shouldn't be an issue here. So great episode, guys. Appreciate it. For each of you listening, if you want to learn more about Keen Wealth Advisors, please visit us at keenwealthadvisors.com. Make sure you subscribe to the podcast and on the YouTube channel as well if you haven't done so already. Tell all your friends and colleagues about the great work that we're doing here. We love to spread the news and get more people listening to what we're doing here and really helping people become more financially literate. So we appreciate that. So guys, again, thank you, and thank each of you listening. We appreciate your support. Take care.
All right. Thanks, Matt. Thanks, Steve.
The Steve Sandusky Advisor Network and Belay Advisor are not affiliated with Keen Wealth Advisors. Opinions expressed by Steve are his own and not necessarily the opinions of Keen Wealth Advisors. Keen Wealth Advisors is an SEC-registered investment advisor. Advisory services are only offered to clients or prospective clients where Keen Wealth Advisors and its representatives are properly licensed or exempt from licensure. The contents of this podcast are intended for the residents of the United States of America. No advice may be rendered by Keen Wealth Advisors unless a client service agreement is in place. This program is intended for informational purposes only and should not be construed as advice on or a recommendation of any particular investment, strategy, or as tax or legal advice for your specific situation. Keen Wealth Advisors is not a tax or legal advisor. To determine which investments may be appropriate for you, consult your licensed professional prior to investing. Information in this program was compiled from sources believed to be reliable. Due to the constant state of data changing, we do not guarantee the timeliness or the accuracy of the information provided. Our views or opinions at the time you are listening to the podcast may be different than they were when the podcast was recorded. Past performance is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any prices that are referenced or market forecasts are as of the date stated and are not necessarily our opinions moving forward. As always, please remember, investing involves risk and possible loss of principal capital. This podcast is not allowed to be copied, distributed, published, or reproduced without permission from Keen Wealth Advisors.